السلام عليكم ورحمة الله وبركاته. بسم الله والصلاة والسلام على رسول الله صلى الله عليه وعلى آله وصحبه ومن والاه. Today, inshallah ta'ala, we are going to look at the products that are used by Islamic banks to finance the different needs of its customers. We have two types of financing contracts. We have what we call profit and loss modes of financing, or participatory modes of financing, and here we are going to look at mudaraba, what we can define as finance by way of trust, and then we have musharaka or investment musharaka. Now mudaraba is a contract where you have a capital provider and an entrepreneur who are referred to as Rabbul Mal and Mudarib. Rabbul Mal in the case of where we are using Mudaraba to finance different needs of the customer is the bank would be the Rabbul Mal, the bank would be the capital provider, and the customer is the entrepreneur or the Mudarib. Now this contract, as we initially stated in the previous programs, is the contract is employed by Islamic banks in both the liability side and the asset side. We mobilize deposits using this contract, Mudaraba contract, and we also employ the same contract to finance the working capital needs of our customers. Now to explain Mudaraba, you have a capital provider who of course will provide the capital as the word denotes, and you have the entrepreneur, the businessman, the client or bank's customer who is in need of funds to do a certain business. And we have two types of mudaraba. We have restricted and unrestricted. In terms of the contract itself, or the principles in this contract, the capital provider, the pillars of this contract, we have the capital provider, we have the businessman, and then we have a profit sharing mechanism, and in the event of a loss, the loss will be borne by the capital provider alone. Now Muslim scholars give some guidance, some form of guidance in terms of profit sharing mechanism, because we have already discussed this contract. What I would want to highlight here is the guidance given by Muslim scholars in terms of sharing of the profit is if the venture or the business is capital intensive. If the business is capital intensive, then the capital provider should get the bigger share or a bigger share of the profit. And if the venture or the business or the mudaraba venture is effort intensive, then the mudarib, the entrepreneur, the businessman should of course earn or get a bigger share of the profit. Of course, this is not cast in stone. It is based on agreement of the capital provider and the entrepreneur. So in this case, a customer walks into the bank and he says, I want a loan. I'm using the word loan because this is what people or bank clients always would come to the bank and they say, I want a loan. They don't understand that Islamic banks do not give loans, but what Muslims, an Islamic bank would do is understand the need of this customer. And if, for example, somebody has come with an application to finance a tender, I'm giving examples of how Islamic banks employ mudaraba contracts to finance needs of the customer. So someone has won a tender, he does not have any capital, so he comes to the bank. He has won a tender of, let's say, $1 million. And he requires, of course, $1 million either to do a certain contract, supply goods or services. So he requires this working capital. He comes to the bank does its due diligence analysis, and if it is confident or comfortable that this is a viable venture, then it can go ahead and give this customer $1,000 or $1 million. So that is the capital. So you have the capital provided the bank, and you have the capital here in this example $1 million. Then most important is they have to agree on a profit sharing mechanism. Yes, we have seen that this is a viable project. It is a viable venture. We have given you 1,000,000 shillings. How are we going to share the profit that you're going to generate from this tender? It could be, as I said, 50-50. It is based on agreement between the capital provider and the entrepreneur, or between the bank as the financier here and the customer. Let's say they agree on a 50-50 or 80-20, sorry. The bank is going to take, let's say, 70 or 20, and the customer is going to take 80 or 30. However they agree, it is based on the agreement. And in the event of a loss, that is not, is not made by the customer, or the loss, he did not contribute, or he did not mismanage that business, then that loss is going to be borne by the capital provider, in this case the bank. So this is how an Islamic bank would finance a customer. It is there is a misconception where some believe that Islamic banks do not give cash, because if they were to give cash, then that is a loan. No, it doesn't have to be a loan. It is an investment. We are partnering with the customer, and in this mudaraba, the bank is giving working capital, and that is its contribution, and the customer is going to contribute his effort, his business skills, and he does the business, he runs the business, and whatever he generates, they are going to share. In the event of a loss, the customer is going to lose his sweat, his effort, and the bank is going to lose its working capital. So this is how mudaraba as a contract is used by Islamic banks. It could be any type of trade or venture or business. So long as it is a Sharia compliant business, the bank could give a customer money, do the business, we agree on the repayment period, the investment period, we agree of course on profit sharing mechanism, we of course agree on the business venture, where are you going to invest this money. As I say, there are two types of mudaraba. It could be restricted, it could be unrestricted. Restricted, it could be that the customer has applied to utilize these funds, or to inject these funds in a particular business, so it is only restricted, this facility is restricted to this line of business. If the customer decides that, okay, part of this money I'm going to put it in this business, and part of the money I'm going to put in another business, then he has mismanaged the business itself, or rather he has violated the contract, and this of course now would be taken to Sharia department, where they are going to give their guidance. But this is how mudaraba as a contract, in terms of working capital provider and an entrepreneur, and the profit sharing mechanism, and the loss being borne by the capital provider, is employed by Islamic banks to finance your needs as a businessman. You want to start a business, you want to expand your business, you want working capital. This is how the bank could finance you to address your financial needs or your business needs. So this is one of the contracts that is employed by Islamic banks. Of course, as I said, Islamic banks were earmarked to be high on profit and loss modes of financing, but generally what you find today in the Islamic finance or Islamic banking industry is that mudaraba and musharaka constitute a very small percentage of their portfolio. Generally you would find less than 2%, less than 1.5% in Islamic banks. But I would say that this is one of the best contracts, but were it not for the risk implications, where customers might not necessarily declare true profits, or even mismanage the business, because they already know in the event of a loss, then that loss is borne by the capital provider alone. You find that banks shy away from this contract. The second contract or product, as we would term it in banking, is a musharaka or investment musharaka, where a customer might come to the bank and he says he wants funds to do a business, but he also has part of the capital that he requires. He requires $1 million, and he has 500,000. He already has half of that money, so he only requires half of the capital. He comes to a bank, to an Islamic bank, and he says he wants, part of this working capital, and this is the way we would finance this customer. The agreement would be that yes, we will give you half of the working capital, you inject your other half, and you do the business. Again, there has to be a profit sharing mechanism. We will not give you, let's say, $500,000 and tell you we want 1% of a $500,000 or 5% or 20%. Rather, it would be a profit sharing mechanism. Yes, we have injected 50% of the working capital, and you have also injected 50% of the working capital. In terms of profit sharing, it is based on the understanding. We could have injected 50%, but we tell you we want 60% or 70%, and you take 30%, or vice versa. We have injected 50% of the working capital, but we're only going to take 20%, and you take 80%. However we agree, or based on the bank's policy, financing policy, however you agree, then that is Sharia compliant, so long as the agreement is on the profit generated by the musharaka venture. So the capital has to be agreed upon. Secondly, there has to be a profit sharing mechanism, a percentage of generated profit or expected profit, and in the event of a loss, the loss is borne by each capital provider based on his contribution. If I contributed 50%, in the event of a loss, I will take 50% of the loss. You have contributed 70%, in the event of a loss, you'll take 70% of that loss. So loss is borne based on the capital contribution of each partner, but profit is based on agreement. So this is another way of financing your needs in Islamic banks. You find that these two contracts, as I said, they were earmarked to be the hallmark of Islamic finance, and you'd find that because they are not loans, when we give you money, and this is what you call the inverted pyramid. If you're to look at a pyramid, you say that on the top you have debt, and on the bottom you have wealth. If you continue getting facilities from an Islamic bank, the wealth that is generated will always be bigger than the debt that is created. Yes, we are calling it a debt as an obligation to return the money back to the bank, though it is not actually an obligation, so long as if you have not generated, or even if part of that capital has been eroded through the business venture. But we just call it, loosely term it as a debt. You have taken money from a bank and you want to do business, you generate more wealth at a higher rate than the way you generate that debt, and that is why you find an Islamic economy is more stable than the capital economy, where the capital economy, you have wealth is at the bottom, you have an inverted pyramid, the wealth is at the bottom and the debt is on the top, so that you find that the debt grows as the inverted pyramid becomes bigger and bigger. What happens is ultimately there has to be a crash. And this is actually even what they are calling it themselves. They say a financial crash, financial crisis. There has to be, it has to be, because wealth that is generated or created is not created in tandem with the debt that is created. The debt grows at a faster pace than the wealth that you're trying to create, and ultimately you always have a crash. And you find that, of course, that is not sustainable, but from a Sharia point of view, what you have is that, yes, you've taken money from a bank, you have generated something, you will only share, or rather you will only pay the bank upon when you have generated something out of that money that you took from the bank. And this is how you create wealth. And you create wealth not in tandem with creation of debt, but wealth is created faster than the debt that is generated or created in terms of the Islamic economy. So the second contract, we have looked at mudaraba, and we have looked at investment, musharaka or musharaka, ending with ownership. Now let us look at another contract known as musharaka ending with ownership. Diminishing musharaka is a contract that is also employed by Islamic banks to assist customers acquire assets. The difference between investment musharaka and Musharaka ending with ownership is, in musharaka ending with ownership, we are talking of assets, whereas in investment musharaka we are talking of working capital. Of course, you'd find that this is a unique way of differentiating between financing working capital and financing assets. And this is something that I would say maybe it is actually unique to FCB. What I know of the wider Islamic finance, Islamic banking industry, is that musharaka ending with ownership, or musharaka al-muntahiya bit-tamlik, or musharaka al-mutanaqisa, is used to finance working capital needs and also to finance assets. But for us, we have used these two terminologies to differentiate between working capital and, a customer who is willing, or rather needs to acquire a piece of land, a motor vehicle, a truck, or even construct a house. So how we finance our customers using this diminishing musharaka, or rather we actually term it musharaka ending with ownership rather than diminishing musharaka, because diminishing musharaka in the wider Islamic banking industry means working capital. We give you working capital and then you'd buy the bank out, and then remain, of course, a sole proprietor, or a company that does not has not partnered with the bank after the facility has been paid off. So a customer walks into the bank and he says, I want to acquire a motor vehicle, and I have, let's say, X amount of money, 10%, 20%, 30%, 50%. So he only requires another 50% so that he can acquire that motor vehicle, or that piece of land, or that house. It could also be real estate. What we will do is we give him, or rather we can either give him, because from a Sharia point of view, one of the partners could either go and pay the vendor, or one of the partners takes all the money and pays the vendor. So if one wants to acquire a motor vehicle, he has, let's say, 50% of the price. He wants another 50%, would give him the 50% to pay directly to the vendor. And after we have acquired, that is the first level of that agreement, or that is one of the agreements. So after this agreement, where we have acquired a motor vehicle, we have acquired a truck, we have acquired a building, a house. After that, then we have a separate contract where we will offer our share, of course, at a price based on the repayment ability of the customer, so that now he buys the shares or units owned by the bank slowly, gradually, until he owns the house alone. And this is why it is called musharaka ending with ownership, or diminishing musharaka, where ownership of the bank diminishes while the ownership of the customer, of course, increases until he becomes the sole owner of that particular asset. So you find in this case, even in instances where people complain that the difference, there is no difference really between this structure or this product and conventional financing of the same need, I would say there are fundamental differences. And one of the fundamental differences is that the relationship between a conventional bank, be it on the liability side or the asset side, is always lender-borrower. When you open an account, you have lent your money to the bank and you will earn interest out of that. And when you take a loan from a bank, you are borrowing from the bank. So the relationship, whether it is in the liability side or the asset side, is always lender-borrower. But the relationship between an Islamic bank and you as a customer would either be buyer-seller or a partnership. In the previous two contracts or two products that we have looked at, it's a partnership, purely a partnership. In a mudaraba, you're a partner with the bank would put its money, you put your effort. In an investment musharaka, you both put your money, and of course the bank would not put any effort, although it is allowed to put also its effort in terms of managing or running the business. Now, in a diminishing musharaka or a musharaka ending with ownership or asset finance based on musharaka, once we have acquired that asset and now you start paying, you actually start buying the units of the bank. One of the challenges and the key challenges we actually find in these contracts that we employ in Islamic banks is that, yes, we have inherited bankers or professionals, from conventional banks, and their understanding of the products is that, yes, we have just come with an alternative to conventional financing, and they would not relay the correct information that, we will tell you, yes, we'll give you 500,000 and you will pay us this much. No, it is not an issue of we'll give you 500,000 and you will pay us 600,000. No, it is a case that, yes, we will partner with you, acquire this asset, and we will sell our units gradually, and of course at the end of the day the bank is there for business. It will generate something out of sale of its units. So even in a situation where you'd say, if I were to go to a conventional bank and I was given 500,000, I would end up paying, let's say, 600,000. And you came to an Islamic bank, you would say generally the same thing, would happen. The difference still is there because the relationship here is now a buyer-seller. I am selling something to you. In the event that asset becomes, or rather is destroyed, it is stolen, the relationship ends there. If it is destroyed, let's say it is a motor vehicle involved in an accident, it becomes a write-off. There is nothing for you as a partner or as a buyer in this case to sell to us, and therefore there is nothing for us to expect from you. We would not be talking of an outstanding facility, rather would be talking of that asset we were to sell to you or we were selling to you is no longer there, and that relationship ends there. Yes, I could hear maybe somebody is thinking out aloud there and saying that maybe there is a takaful, that car is covered and you will be paid by takaful, even in the event you are paid. At the point where you are paid, we are talking of my existing ownership in that asset, and as a customer I also have ownership in that asset. When we are compensated, I am only entitled to my share of that asset. So if I own at that point 30% and we are paid by takaful, I am only entitled to 30% of the compensation and you are entitled to 70%, regardless of the outstanding facility. And this is a key difference. We are not talking of a loan that you have an outstanding loan facility of this much, but we are talking of an outstanding share that I've not sold to you, that belongs to me as a bank. So at that point, even if we are compensated by takaful, I am only entitled to my share of ownership in that destroyed asset, and you're also entitled to your share. So we find still there are key differences, even in this structure that is very similar. But as I said, the difference between Islamic banking and conventional banking in terms of the products, in terms of the financing activities, is in conventional banks the relationship is always lender-borrower, and whatever you pay the bank in terms of that loan, you pay riba, and in terms of you as a depositor, you are paid riba. So that is totally haram. But in an Islamic bank, you are either a partner or you have a buyer-seller relationship. Now let us look at, we have looked at participatory modes of financing. Now let us look at debt modes of financing. We have looked at mudaraba as a profit and loss modes of financing. We have looked at investment musharaka as a profit and loss mode of financing, and we have also looked at musharaka ending with ownership, where it actually lies in between a debt mode of financing and a participatory mode of financing. Yes, there's a likelihood of you losing as a bank, there's a likelihood of you losing also as a customer. But in debt modes of financing, what it means is that immediately we finance you, we have actually created a debt. You owe the bank. And this, as I said earlier on, and I reiterate this point, what Muslim scholars have done is transform trading instruments into financing instruments. So in terms of debt modes of financing, we have murabaha, a cost plus financing. We have ijara, leasing, and we have salam, an advance purchase or a forward sale, depending on where you are standing. Buy bithaman ajil, deferred payment financing, and we have istisna, commission to manufacture. Now let us look at murabaha. Murabaha is a very simple contract and a straightforward contract. It's called murabaha to the purchase orderer. To define it, a customer walks into the bank and he says, I want 50,000 Kenya shillings. The general, question would always be, or rather would always be asking the customer, why do you want the money? He says, I want 50,000 to acquire a fridge, I want 50,000 to acquire a laptop or a computer or any other, asset. So the bank would do its analysis, and generally when you're doing analysis for this particular contract, you're looking at the ability of the customer. You will ask the customer, first of all, to give you a promise to purchase from the bank, that yes, we are going to finance you, but we are not going to give you cash, we are not going to give you money, we are going to sell to you that asset that you wanted to buy. So rather than give you 50,000, we are going to tell you, we will buy that computer, give us the specifications, we acquire the computer, and we are going to sell it with a markup. We are going to sell it at a profit. So instead of selling it to you, we acquire it at 50,000, we sell it to you at, let's say, 60,000, to be paid on deferred payment basis, to be paid in 12 installments. So the relationship, again, as I said here, is a buyer-seller. We acquire the asset, we buy it. We have different regimes, if you like, where some banks would make the customer its agent. He goes, acquires the asset, and and he informs the bank that I have acquired the asset on your behalf, please sell it to me now. And then the bank gives an approval that now we are selling it to you. No, we don't do that. We do not find that to be Sharia compliant. And what we do is that the bank will literally, physically go acquire the asset, send one of its officers, acquire the asset, and sell it to the customer. So it acquires, it has possession, and then it sells to the customer at a profit. And you find that nobody would differ that this is not Sharia compliant, because so long as you acquire the asset, you possess the asset, you are allowed to sell it. What happens is, you have some banks, they do not necessarily do it themselves, but rather they make the agent, they make the customer their agent, and he acquires the asset on their behalf, then he sells it to himself as agent of the bank, and then as himself when he's acquiring that asset. We do not find this as Sharia compliant, and what we do is we'd actually literally buy the asset and sell it to the customer. Now once we have sold that asset to the customer, it becomes a debt. Whether this customer is able to offset or to repay the selling price at that juncture or not, that is a debt, and that is why they are called debt modes of financing. Once we have sold something to you, let's say we have sold a computer to you, you have acquired it, you go out there, it is stolen, you still owe the bank. Contrary to the previous contracts that we spoke about, participatory modes of financing or profit and loss modes of financing, there is a possibility of gaining and there is a possibility of losing. Some of our Muslim clientele, Muslims out there, they tend to only focus on these participatory modes of financing, and they tend to believe that Sharia is just, and it's as if there are no selling contracts, there are no debt modes of financing. Yes, there are debt modes of financing. If you are to go to any shop and you bought something on deferred payment basis, you owe the shopkeeper, you owe the the grocery shop, you owe the vendor, and this is something that is of course allowed. And how would this be different when it is done by an Islamic bank? You still want, just because we sold to you a computer and then it was stolen, you want the bank to share in that loss? No, this is not possible, and it's not even Sharia compliant. It is not halal. There's justice in Islam, and this is something that is allowed. So what an Islamic bank would do is basically look at the needs of the customer. If it is, let's say, construction finance, this is a contract that is also possible to use in construction finance. You're constructing a building, a house, and you come to the bank and you say you want X amount of money. So the bank would actually acquire the building material. It could be stones, it could be sand, it could be ballast, it could be iron, roofing. So they buy and they sell them to you, of course, at a profit, and this is something that is allowed. It could be inventory, working capital. Even murabaha could still be used in working capital, where you say you want X amount of money to acquire goods, of course, and sell them. So we buy them and sell them to you. Also, murabaha is employed in Islamic banks in LC financing, letter of credit, where a customer comes to the bank and he wants to import goods or assets from another country, and he has an LC. So the bank acquires, or it buys that asset from Japan, from UK, from wherever, and then it sells to the customer. So even an LC, or rather an LC, is actually financed through murabaha. So you have a LC murabaha line or LC murabaha as a product. So we have a number of needs that are met actually by these products or these contracts that are already there in our books of fiqh. So this is a murabaha, and this is how it is employed by Islamic banks to finance the needs of the customer. Another contract is ijara. Ijara is a lease, and ijara, the lexical or linguistic meaning of the word is, you could either be working in employment. We are talking of employment also being an ijara, a form of ijara, and it could also be that you are renting. You're renting either a car, you're renting a house, you're renting a machine, you're renting an item, and because you're renting this, an Islamic bank could also acquire that asset. It could acquire that house, it could acquire that motor vehicle and rent it to you, of course, for a profit. The rental income forms the profit of the bank. And basically, to sum it up, and inshallah we are going to revisit ijara in the subsequent lectures, how we have seen how an Islamic bank mobilizes deposits and how it invests or utilizes these deposits. So all this income that is realized through mudaraba, it is realized through investment musharaka, realized through musharaka ending with ownership, realized through murabaha or ijara. This is what is shared by the bank, is distributed to the depositors, because these are Sharia compliant investments, and whatever we realize from these investments we share with you based on the mudaraba contract as defined earlier on. نسأل الله العظيم رب العرش الكريم أن يجعلنا مما يستمعون القول فيتبعون أحسنه. اللهم علمنا ما ينفعنا وانفعنا بما علمنا. سبحانك اللهم بحمدك نشهد أن لا إله إلا أنت نستغفرك ونتوب إليك.